So what have whole life insurance policies looked like for individuals that have started within the past 5 years? In this very low interest rate environment where whole life insurance, there's a lot of opinions around it. Is it a good area to position money? Is it a bad area to position money? Well, what we're going to look at today is a policy that was issued in 2019. It has just entered its 4th policy year, and we are going to track the actual performance. We're going to have a ton of fun looking at the original illustration, what was projected on a guaranteed and non-guaranteed basis, and then we can see, has this policy been performing or has it just been under-delivering and the person is entering a situation where he is going to be disappointed down the road? What will it be? Let's have some fun. So this individual, his name is Lance. I joke with my wife that he is an older version of me. We have a lot of similarities, but he started his policy at age 41. Start date specifically was February 2019, and he has been very disciplined with his policy. His plan was to fund the policy with $120,000 per year for 5 years, and he has done just that thus far. Every year, when his premium is paid, he sends the full dollar amount in, premium dollars, PUA dollars, just max funds the policy right up to the $120,000 limit, which is fantastic when we want to track, is this policy actually performing? Because he had a plan and he has stuck to the plan. So this makes it very easy to take an original projection. Hey, here was the original plan. You've done everything according to plan, so you've done your part. Has the company done their part? That's what we're going to look at today. So there's our study period, 2019, 20, 21, 2022. He's in his 4th year right now. Company selection was Guardian, one of the 4 major mutual companies. He selected them for flexibility. While he has made the full payment up front each year, he likes Guardian because in the event that cash flow dips, he can commit just to a minimum premium payment and throw in extra PUAs at his discretion. So the performance, this is the big thing, because when it comes to whole life insurance policies, they often underperform. Now, the design and company selection is critical here. We talk about that all the time, so I'm not going to get into all of the detail there. But whole life insurance products have a tendency to underperform. Yet we hear stories about the ultra-rich, banks, corporations putting a ton of money into cash value life insurance, and it benefits them. Specifically, they're interested in the cash value, so we know that it works. The design and company selection is key. This individual and everyone we work with, we set them up to copy what the corporations do with respect to company selection and policy design. Here's the design. 1090 split. What that means is of the $120,000 payment, his premium is a clean $12,000. We're going to walk through the original illustration. He's got a term rider attached that costs a little bit less than $1,200 per year, just rounded up for this example. And then everything else went into his PUA, stands for paid up additions rider, the 1068, just dumped it into cash value. That does purchase him additional whole life insurance as well. We'll pull up the illustration so you can see exactly how it has worked thus far. So let's have some fun. Before we just dive into the Excel spreadsheet, this was made to simplify everything. Let's take a look at the original illustration. So in 2019, and this was based on Guardian's 2019 dividend rate, which you may or may not know, Guardian's 2019 dividend interest rate was 5.85%. So anytime you look at a life insurance illustration, unless the agent adjusts the illustrated dividend rate, that illustration is going to assume that the same dividend rate is credited forever. An agent can elect to reduce the dividend rate to show things more conservative. We can even show just the guarantees if we want. But if we make no changes at all as an agent, when we look at the non-guaranteed ledger, it's going to assume that that dividend rate, in this case 2019, remains the same forever. Now, he started the policy in 2019, in 2020, 2021, and 2022. Guardian's dividend interest rate came down. Well, it's been this rate for the past 3 years, 2020, 2021, and 2022, 5.65%. So it's dropped by 20 basis points, slight reduction, but now we can really see, okay, how much has that slight reduction impacted his cash value performance? Because he's pumping in 6 figures per year into this product. He really views it as an alternative to store cash money just piling up in the bank account that he still wants access to for opportunities. So as we look at the breakdown here, where is the money going? 41, he received the top health class. This is the original illustration, 2019. In fact, we can see that bottom right-hand corner of the illustration, February 12th, 2019. This is when he started the policy. So let's go back here. Where's the money going? Top right-hand corner, we see the premium, $12,000. There we go. That buys him a whole life death benefit of just about $650,000. Now, if we stopped there, his MEC limit would not be that high. It'd be about $20,000 to $25,000 in this example. His total death benefit here under current represents the current dividend rate when this illustration was run, $2.9 million. So what happened here, we've got this term insurance rider attached. This is a very cost-effective way to raise the death benefit, which raises the MEC limit. That MEC, we want to prevent that so we don't have to deal with taxes. The MEC limit in this example is almost a clean $120,000. Add those two figures together, you get the 2.9 million, which we see right here. Okay. So here's what I want to look at. We've got the current dividend interest rate and then also the guarantees. This product had a guaranteed interest rate of 4% when it was issued. Still has a 4% guaranteed rate. If you have an older product with a guaranteed rate of 4%, you're locked in forever. So when we look at the guarantees, check this out. It's $120,000 times 5. $600,000 total. Based on the guarantees, there is his break-even point. When we look at the non-guarantees, we've got year 4 highlighted in yellow. The reason why is because he's in policy year 4 right now. So if I'm him, and this is the stuff I want to point out to him and everyone we work with for that matter, is what does the policy look like with respect to the actual performance? We like to look at this every year. Is it performing? Or is it really under-delivering? The dividends come down a little bit, but 20 basis points should not have a huge impact in this case. So let's have some fun here. What we've got next is what is referred to as an in-force illustration. So this is based on the 2022 dividend interest rate scale, which is 5.65%. We've removed his name and policy number just for confidentiality purposes. But what do we see here? Risk class, preferred plus, date of issue, February 13th, 2019. Okay, there we go, all this good stuff. Base premium, well actually before I just jump to the base premium, look below the red line, policy year 4. Anytime we run an in-force illustration, it represents the year we're in right now. So policy year 4 is what he's in. There's your base premium. There's the total payment for this year, $120,000 clean. So 120 goes in. Here's the cash value, $485,220. Death benefit still $2.9 million. His whole life death benefit is increasing. As his whole life death benefit increases, his term comes down. That's how the 1-year term rider works in this example. If you have questions on that, let us know. You can email us, or we've got other videos that touch on that as well. But my point here, year 4, $485. Going back to the original illustration, dividend has come down a little bit. It projected $487, almost $488 in that example. So very, very close when we look at the year 4 performance. The thing to look at here though, and this question comes up sometimes, is like, all right, this is great because I see that the value is tracking by year 4, projects 485 at the end of policy year 4, 485 and change. The original is 487 and change. Call it $2,700 behind, 20 basis point reduction the past 3 years. That makes sense. What I don't like about in-force illustrations is they start in the year that they're run, policy year 4. What about years 2 and 3? If I have a policy that's 15 years old, this would say year 15. What about all of the prior years? One of 2 things have to happen to get a complete picture. One, your agent has to run an in-force illustration every single year, but the actual performance can be different than the illustrated performance. Or the second thing, and this takes just time, there's no other way around it, is you have to pull the annual statements, which the policyholder receives by mail or email nowadays, and so does the agent. So what we do, this one was easy because the policy is 4 years old, but we've done this with much older policies as well, is pull the annual statement from each year, pull the cash value, pull the death benefit, match it up with the in-force illustration, see if it performed, and do that every year. If we haven't done it in a couple of years, or if we inherit a policy, if we were made a servicing agent for a very old policy, we do the same thing. Sometimes it takes a lot of time, a lot of work to put everything side by side, but that is what I would refer to as the boring work that really helps you as an agent elevate your game. And that's really, if you're a consumer or potential consumer, what you want to look for with an agent to make sure you can get all of this material portrayed to you in a simple manner and it's easy to follow. So let's take a look here. When I say in a simple manner and easier to follow, you want to be able to obtain all of this info and feel like you don't have to pull teeth to get it because it can be confusing sometimes. Forgot something very important, the annual statements. Let's take a look. So that was the in-force illustration. Annual statement number 1, Guardian, one of the major mutual companies. Scroll down here. 2020 annual benefit statement. This was at the end of his first policy year. So here we go. We've got the 13.2 as far as the premium that's due. Remember, that's the base premium, and then also the term insurance rider as well. The term cost is a little bit less than that. Everything above the term just goes into PUAs here. But as we scroll down, here's what we want to look at. These statements are very easy to follow, aren't they? I used to look at these things and just say, what? So, basic policy. This represents the benefits from the pure whole life insurance policy. So we had a $12,000 base premium. That's the whole life death benefit generated as a result. And from that $12,000 base premium, there's the cash value, $450. With the base premium, we always talk about the worst year of a whole life insurance policy. If I don't die, if I'm focusing on the cash value, first year. The premium, specifically the base premium, does not show up in cash value. This is a big pain point for customers. So there's the first year cash value derived from that $12,000 payment. Like that's a big hit. Imagine if your premium was $100,000, or maybe it's just $1,000. It's all relative based on the amount of money someone's paying in, but that's the base premium benefit. Here we've got the term insurance rider. The cost is not here, but that's the initial benefit. But then we've got the paid up additions rider. Okay, paid up additions. There we go. Cash value is 105 and change. Remember, we paid in a little bit more than that. And where we can see that, if we go back to the illustration, we go back to the original, here we go. So how you can get the exact PUA payment, 108 minus the cost of the term here. So if we were to look at that, 108 is your PUA rider. Deduct the term cost minus, I'm just going to round up, 1,113. There you go. 1068, almost 1069. If we go back to that statement, what do we see the PUA cash value? 105. Remember that there are PUA fees associated with this policy, really with all policies. Year 2, you'll see the compounding exceed the fees in this particular example. And with most policies when you look at it. But main thing, cash value at the end of the first year, total cash value, including the base premium cash value buildup and the PUA cash value buildup, 105,528. If we round up, it's 105,529. Here's why I mentioned that. Let's go back to the original illustration. Current cash value, 105,529. Current is based on the current dividend rate and current expenses. Guaranteed, the first year, the guaranteed and non-guaranteed is the same in this case. So that's easy, but we see that it matches up. Perfect. Year 2. Statement. Let's make sure we get the right year. Annual benefit, 2021. Let's take a look, shall we? Same thing with the minimum premium build, the additional PUAs he's dumped in at leisure. So, cash value build up just from his $12,000 base premium in that year. Okay. Down here, what do we see? We see a dividend is credited to the policy. Okay, beautiful. We see the term rider. Now, term rider premiums do not build cash value. That's actually the cost of the term rider there. It's laid out in this particular statement, but that's okay. And then we've got the paid up additions rider. He did not pay in $214,000 this particular year. That's a combination of years 1 and 2. Here's the main thing to look at. Total cash value, $228,000 to $277,000. And remember, this is 2021, the second policy year. The dividend interest rate is now 5.65%, has come down a little bit. So if I'm him, my question would be this: the 228 and change, what does that look like compared to my original issue illustration? Is it tracking performance? I understand the dividends come down a little bit, but not that much, and I max funded it, so it should be close. Let's look at the difference here. 228, 227. Original illustration was what? 228, 612. A couple $100 makes sense. Let's look at the most recent annual statement, updated look. I like their new statements, how they display the cash value buildup like that. And here we go. So let's just go to current values, make this simple. Cash value, $354,143. There's the total cash value over 3 years. So if we're going to do the same thing and look at the buildup here, $354,143 compared to year 3, $355,406. And remember, this original illustration, 5.85%, even though the dividend rate has been 5.65%. So it's come down a little bit. That's why we have a little bit less there. So performing quite nicely. Dividend additions. So Guardian, I like the language they use here. You have chosen to have your dividends reinvested into your policy, a reinvestment referred to as dividend additions. These additions increase your cash value and purchase additional death benefit. So what's happening here, and you can notice it on this one as well. Remember what the term rider was on the first illustration? It was 1.3 million and change. Right, I think it was higher than that actually, 1.7 I think. Now it's just over $1 million. So what's happening is as his whole life death benefit's increasing, his term rider is coming down, and so does the cost. This is why we see the cost here, $695, whereas last year, if we go back, do you recall what that was? $851. So the cost is gradually decreasing, which is perfect. So a lot of back and forth with the statements there, which I like to do. Let's look at our Excel sheet here. Do the same thing. So put it side by side. Original illustration 2019. We've got the dividend rate here, which is assumed 5.85% forever. Obviously that didn't happen. It's come down. Here's actuality, 5.85 in the first year, which doesn't matter because dividends are not paid. Next 3 years, 5.65. That's exactly what it has been. And here we go. So total payments, look at this. Break-even point between years 3 and 4, which is exactly what he wanted. That was what was of interest to him, because again, he viewed this as an area to move some excess cash that he had, wants safe money that is still accessible for real estate opportunities. He's heavy in real estate investing, has done well, so he wants his money liquid for that reason, and he was comfortable with the initial hit. He said, I think I'll be fine with that. I don't need access to all of that right now. It was about a $15,000 hit. But there we go. We did look at some additional projections, which I don't have here, that displayed what it looks like if he decides to keep pumping money in, because he does not have to stop after 5 years. However, that was his initial plan. One last thing I forgot about this spreadsheet, the annual internal rate of return. So I met with him 4 years ago, and I've talked to him since then, obviously. But the dividend rate, 5.65%. A lot of times people hear that and think, okay, if I've got $100,000 in cash value, 5.65 would be $5,650. That's what I'd see in growth, right? Not quite. The reason why is that dividend rate is a gross rate credited after the cost of insurance and such. So the annual internal rate of return is the net growth rate on cash value, and this isolates the annual IRR, what's projected on a year-by-year basis, not the average internal rate of return, which I could look at the 10, 20, or 30-year average. I don't have that in this spreadsheet, but you can search any video on our channel. We've got it on a lot of them. Anyway, here we go with the annual IRR, the original projection. Let's look at this. So if I look at year 4, because that's what he's in right now, 2022, based on a 5.85 dividend, the IRR that year was 2.62%. It's come down to 5.65%, 2.34%. So it's a little bit less than 20 basis points. However, when he stops funding, particularly when he goes reduced paid up, here's what's extremely interesting. Well, I don't know if interesting is the right word. Consistent is a better word. There's your annual IRR when you have a dividend of 5.85. And here's what it is when you've got a dividend of 5.65. No difference there. 0.2, or I should say the difference is exactly what you would expect, 20 basis points. That's not always the case. It's definitely not the case when you're paying into it, because you've got premium loads and other factors that impact it slightly. But once you go RPU, generally, depends on the company and product, but generally speaking, you will see a consistency there. So I hope you enjoyed this one. I always love looking at actual policy performance. You can really dig in and have some fun. If you did, please hit the like button, subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.